Kia ora. This is a tutorial on preparation of the financial statements using what we know about the requirements of the Financial Reporting Act, the Companies Act, and the External Reporting Board, international accounting standards equivalents. Okay. The format I'm presenting this in is the same format as you'll get during the exam. All right. On the left-hand side, you will have the information. On the right-hand side, you can do your workings. All right. So down the left-hand side, provide you the information. We'll be going through that in the course of completing this exercise. Underneath the information is your actual answers, where I'll be marking. Okay. I'll also be marking some of the workings as well. Okay, so typically mainly the trial balance and that sort of stuff, but this is where you're going to have to get that right to get the statements right. So the answer format, QA, question A, is the statement of profit and loss and other comprehensive income for the year ended, okay, also known as the income statement and other comprehensive income. Okay, B is the statement of changes in equity as required. C is the statement of position, okay, and D are the notes to the accounts, okay, providing detail around the figures you put at the end, okay. Okay, so the Kelly Fielder Limited was launched in 2005. You were provided with the trial balance for Kelly Fielder Limited as the 31st of March 2017. Here it is down here, okay. So there's the trial balance, okay. Prior to you having to do some adjustments, okay, so you'll need to do some adjustments in here and get in the amended balances, okay. You'll see in this worksheet that I've set it out in a way that is useful for me, so hopefully for you, is I've added some columns, right. Forget about the check one for now, that's just to make sure my figures add up at some point, but the report one, and the check is optional for you, the report one's really useful for me. I put down there what statement it's going to end up in, and then I try and sort them a little bit so that I've got them in some sort of order, not so my eyes are darting all over the place trying to find things. Okay, so I can see I've got my two income statements, income accounts at the top, then I've got my expenses that are in the statement of performance or the income statement or the profit and loss there. They are in alpha order, income statement, that's the I. I'll put the equity ones together, I'll put the balance sheet ones all at the bottom. Even then I've gone CA is current asset, CL is current liability, FA is fixed assets, BIA is investment, BLL is a liability, a long-term liability. Okay, so I've done that to help me. So I'll leave your template will be set up like this, right? Because I know that you're going to be limited for time. But if you're ever given things, raw sort of trial balances, try and sort of put them into some sort of order to help you to start with. I've also gone to in color coded here because I know that when they want us to classify expenses, some of them are going to be apportioned. So what I've done is I have color coded the ones blue that need apportioning, so that it makes it quicker for me, not going, and I don't get lost. I've got my sort of balances here. I've added a column for other. Okay, so basically I should have all my expenses there, all right, and that's where I sort of do this checky thing, because then I can check to that. Okay, then there's just the next thing I have to do. I have to do that is put some notes to the accounts and take these balances into the accounts. All right. Okay, so let's go back to the information that we've got. Okay. Right. Moving that around. Okay. That's better. Okay. Right, let's kick it off. Okay, so you've got the trial balance. First thing is depreciation. Just so you don't have to watch me type, I have typed in some of the stuff like words, which isn't a big deal. Don't need me to show you how to type. Okay, so depreciation on the building, we know it's 5%, we know it hasn't been calculated. I go down here, find the building, find the value of the buildings, and that is times 0.05. Okay, so that's the depreciation I need, and that will increase the accumulated depreciation Journal 1 complete. Final dividend 2. So I've referenced these are close to the notes. The directors wish to provide a final dividend of $45,025 for the reporting period ended 30th March 2017. Great, we could do a journal to bring that in. This is yet to be approved by the shareholders at the annual general meeting. Okay, all right. Okay. Final dividend. As the dividend has not been approved, no adjustment required. Okay, so it's a bit of a red herring, just testing you out. Number 3, the directors request that an amount of $12,800 be provided for auditors' remuneration. So we need to accrue an expense. Okay, so auditors' fees is the expense, and it's $12,800, and the corresponding credit is $12,800, accrued expenses. Cool. Number 4. The Inland Revenue Department only permits actual write-off of debts to be deductible for tax purposes, and this has been calculated in calculating the annual income tax amount of the rate of 28%, which is, okay, so they say that's what the tax is. Right. We will sort of reconcile it, but that is the figure. Okay, so we can just take that as the figure. 54, tax payable 62,254. Okay, that's good. All right, so that's number 5. Okay, there's a loan of $929,000. It's due for repayment. Okay, so there's a whole lot of information there that will need to go in the notes of the accounts. But it carries on to say that there is interest accrued. The interest to accrue is as at 31st of March is 3.6. Okay, so we need to accrue some interest. Recognise the interest expense of 3,600 and the accrued interest payable 3,600. Number 6. He's got some freehold land, was revalued by an independent. Okay, it's an independent, so it's valid. It's in the current year, 3rd of March. Okay, great. The data sale, no adjustment. There's been no adjustments have been made for this previously or now. Okay, so really, what was the land in the books? The land in the books is 1.15 million. So it's actually gone down in value. Okay, so it's a loss. It's a revaluation, loss on revaluation. It's actually, the loss is going to be that minus 925,123. Okay, so that's how much it's dropped in value. We were going to recognise that loss because it's a revaluation loss. We recognise it in the statement on the other comprehensive income section of the accounts. Okay, and you'll see that a little bit later on. Number 7, inventory on hand is 59. Okay, so inventory now is 55,900, and the beginning, because I haven't made an adjustment for it yet, the inventory at the beginning was 64. Okay, so it's less, so we have to reduce the inventory. We need to reduce the inventory and increase the cost of goods sold, so I'm just going to put that to purchases. So that is what the opening balance is. Okay, less the closing balance, which is 5700. Okay, so that if we make this journal, it will reduce inventory down to the right level and recognise that amount of purchases has been sold. Okay, I mean that count could be cost of goods sold, but I just know there is in a purchases account here, there isn't a cost of goods sold one. Okay, so that's the change in inventory. Moving along, capital commitment number 8. 1st of Feb 2017, okay, that's the current year, so that's good. The company entered into an agreement to construct an administration building costing $2.1 million. Construction is expected to commence during the 2017, in July 2017, okay. That's next year. The issue of new shares and loan will be fine. Okay, so that's how it's going to be financed, right? Nothing's happened in the current year, okay. So really, we cover that off with a note to the accounts regards capital commitments, no adjustment required in the current year. Okay, number 9. On the 8th of July, it was found that somebody owed us some money, $55,700. They've become insolvent. We found out in the current year, but we haven't done anything yet. We've got to write that off. It's in the current year, we need to write it off. Bad debts is 55,700. Okay, so again, we're ignoring GST, so it's just purely that. Obviously, if there was GST in that figure, we'd have to split it out. But for this point of this exercise, and to get through a lot more, we're not going to slow things down by testing on your GST knowledge. 10. After any adjustment that may be necessary as a result of the insolvent debtor, well, we've done it, okay, they've decided to make an allowance for doubtful debts at 2%. Right. Okay, but we need to work out what the closing accounts payable is to start with. So probably we want to do that journal after we've worked out that balance, okay, because accounts receivable, okay, so doubtful debts, which is going to be the expense at 2% to allowance for doubtful debts, okay, so it's going to be whatever our accounts receivable is less what we've written off, which is that figure there, okay, it's that, but only 2%, right, 0.02, okay, so that's our provision for doubtful debts, 5,400, okay, just make sure I'm on track here, it's looking pretty good, yep, that's looking good, just check into my previously worked example, okay, cool, we're on track, okay, we've done all that, now we can post these journals, right, so the first journal is depreciation on building, here it is, depreciation on building is that amount, okay, and accumulated depreciation on building is that amount, okay. Okay. Right. Just in case I have to get stopped at any point, I always put posted. Okay, the next one, probably I could just put noted, but I'm going to put posted anyway, so I don't have to do anything. The next one is audit fees. Okay, audit fees are there, it's debit. Okay, and accrued expenses is credit. Accrued expenses are here. Okay, we've got checks and balances at the bottom of our trial balance to make sure that it balances, because it's got a balance by the time we get to the end. Okay, not too sure why I'm getting these figures a little bit hokey pokey up here, but there you go. Right, that's working. Okay, the next one is income tax expense, debit. And income tax payable credit. Okay. Interest on the term loan, interest payable, right, so that goes to there. The other one goes to land, reducing the value of land. It should actually say land. Okay. Okay, purchases. Okay, next note, I've already told you about that. Okay, bad debts. Bad debts, bad debts. Accounts receivable is reduced. Accounts receivable we need to reduce. Okay, just about there. Okay, and the next one is doubtful debts. Okay, and allowance for doubtful debts is by accounts receivable. Okay, because my trial balance doesn't match, something has been missed out. Okay, so this is a good worked example of what's gone wrong here. Okay, so what is the difference for a start? $61,100. Half of that is 30, so 61,100. Okay, I'm just going to tick them off. Okay, that marries up with that. 4420 marries up with that. Oops. Okay, 62, it marries up with that. Right, 36. I can see the 36 and the 36. Okay, 225, 225, 225. Cool. 8530. 8530. Okay. Doubtful debts. Where's that? Wrong column. Equals 520. 5. There it is. Okay. And that one there marries up. Okay. That's the figure there. that is out. Accounts receivable is supposed to be bad debts is there. Yeah, that's right. Again, that's in the wrong column. Bad debts is there. So I just picked up some things in the wrong columns. Okay, that was right at accounts receivable equals that. Okay, cool. Right, so that should balance now. They do balance. Okay, there you go. That's how you can sort out if it's worked or not. Okay, so I'm good with that. That balances. Okay, right, I'm going to do the video in a couple of parts. So that's the first part, right? So that's getting through to this section here. I probably would say, well, why don't we just go get the closing balances? Okay, for some reason I've already left some formulas in here, so I'll get rid of those. Okay, so the formulas for getting these, really, this one is going to be pretty straightforward. Okay, these just are these. Okay, the debit balances on this one for these will be that minus that plus that minus anything there, which makes sense. Okay, so if I just copy that down, it should give me those balances. Okay. Helicopter overhead. So that should give me those balances. Okay. These balances here, there's no changes whatsoever. Okay, so it's safe just to go. That equals that. Okay. Okay. These are assets. Okay, so they're typically going to have a debit balance, except for that one. Okay, that's pretty much that. Minus that. Okay, balance of doubtful debts is going to be a credit balance. Okay, inventory is going to be less. Okay, okay, there's that. Okay, accrued expenses are typically all going to be credit balances. Okay, the building's same as the opening, but it's not a credit balance. Get it right, make sure you get your debits and credits right. Okay, that's that. Accumulated depreciation is going to increase. That plus that. Okay, your land is going to go down in value because of the revaluation. Okay. Okay. The property and plant. No additions, no deductions. Okay. That's right, we didn't have to do it, they'd already depreciated it. So once again, why doesn't it balance? That balanced, this should balance. Okay, so again, what's the difference? And the debits are more than the credits, and it's 332,100. That looks right. So they look all right. It's on the right side. That is. That looks good. That looks good. What's happening here? Bank. Probably need to consider the bank balance. Okay, that's good. Yeah, I'm good with that. Good with those. That's right. That's fine. That's fine. That's fine. 230. Oh, equity. Equity. Better put the equity in. Equity. That's good. And term loan. Sorry. The it's an investment. It's like equity. Okay. Then there's a term loan. Okay, now it balances. Cool. Hey, so it was only just I'd forgotten to do the last 2 lines, so that's pretty straightforward. Okay, so we've posted our journals. We've got all our closing balances. The next step will be analysing and splitting those. But I'm going to stop this video now, and I'm going to do that as a second part. Okay.